Welcome, 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 everyone. Thank you very much for joining us today. We're so excited that we have a gentleman who's got quite a bit of experience in IRAs, self-directed IRAs. So he's going to tell you a lot about what you could do with it, and he's also going to tell you some things you can't do in it. At first, I want to tell you what our company does, what our company does is we work with people who want to be passive or what we call limited partners in commercial real estate and get their K-1s and tax write-offs and have their money working for them so that they have a great retirement or just a fantastic life. It all works. So we have lots of money conversations, which, that's my favorite color and favorite subject. And then we have this lovely little quote here about celebrating and spreading joy. Joy is what happens to us when we allow ourselves to recognize how good things really are. So think about how good things really are. Oh, and I have this little article. I love talking about how we should, excuse me, gotta let Norma in, how we should be talking to our children when they're young so that they understand money and business and how things work. So there's this article it's called Bottom Line. It's a very short magazine, which I really like because it just gives you the quick things. So they are saying, get a piggy bank and have your kids put the money in and talk to them about what that money's going to be for. And they talk about gifting and saving and then spending. And I always call it jars because I think you should have 3 or 4 different ones. And then they say what kind of conversations to have at different ages that your children are. So when your children are like up to 5 years old, you want to give them the piggy banks and talk about that. And you want to talk about what you're using your money for. And when they're 6 to 11, you give them money for doing chores and you talk to them about using some of that money for spending and saving. And then when they're 12 to 18, you let them pick a company they like and help them buy stock through a custodial brokerage. And of course, they don't talk about real estate because you do need a little bit more than $5 or $10 to invest at a time. But we love having that extra conversation about how to grow there. And if stocks and bonds will help you grow there, that would be really great. And today I am very proud and happy to have you meet Jack Malpass as an integral member of the sales team. Jack brings 20 years of customer service and sales experience to his role at Next Generation. As a business development specialist, Jack is tasked with identifying new potential referral sources and clients, educating them on value of self-directed IRAs, and assisting those individuals with new account openings. So Jack, we are so thrilled to have you here today. So please take it away.
Thank you, Peggy. Nice to meet everyone. Excuse my voice. This is my 3rd presentation today, so a little raspy. My name is Jack Malpass. I am the business development specialist here at Next Generation. We're a women-run company. We've been in business for over 20 years. We hold over $800 million in assets under management. And my position is to educate people on how you can use your qualified retirement money to invest in alternative assets. So the difference between what we do and your regular Vanguards or your Edward Joneses of the world is your retirement, whether it's your 401k, your IRAs, your SEPs, your solo plans, they are all in stocks, bonds, and mutual funds. With a self-directed IRA, you can invest in alternative assets. So anything that's not publicly traded on a stock market, you can use a self-directed IRA to invest in alternative assets. And we'll get into what alternative assets are. But the most popular one and the one we do most of is investments in real estate. So people who want to invest in an investment property can use their IRA, and they get the tax advantages of using their IRA instead of their cash. Okay. Depending on what type of account it is, it could be a tax deferred account or a tax advantaged account. So the whole idea is to try to stay away from paying as much taxes as you can. And this is a vehicle for you to do that. Okay. So I'm going to share my screen. And I'm going to roll this back to the beginning. Everybody see my screen?
Yes.
So, like I said, my name is Jack Malpass. I'm the business development specialist. A little disclaimer. The information I provide is for educational purposes only. We are not fiduciaries nor advisors, so we do not give any advice on whether an investment is a good idea or a bad idea. The whole idea of a self-directed IRA is that you decide what you want to invest in. Okay. Now, your companies out there like Vanguard's or Fidelity's say they are a self-directed IRA company. What they mean by that is that you self-direct through their portfolio. You have to choose something from their portfolio. With a self-directed IRA, with our company, we don't have a portfolio to choose from. You go out there, you find the investment, you come to the investment with me, and I can tell you, yes, it can be held in a self-directed IRA. That's it. I don't tell you whether a syndication is a good idea, whether the syndicator is a bad guy or a bad woman or anything like that. I just say, yes, you can hold it. The great thing about a self-directed IRA is you do the due diligence on the investment. So if anything happens with that investment, it's on you. Whether you do great with it or whether you do very badly with it, it's all up to you. Okay. Jamie is the owner of our company. She is a Forbes member. She's a real estate investor herself. She has all these different accolades. So she knows how these things work because she herself is a real estate investor. So she wanted something to do with her stocks, bonds, and mutual funds. And she wanted to do real estate investing, but she couldn't find a way to do it because she was in the stock market. So self-directed IRA was something that she was interested in, and she started the company, and we've taken off from there. Okay. Now, one thing about self-directed IRAs, everybody thinks that this is only for the rich or people who have a lot of money. Okay. That's a misnomer. Okay. The only thing you need to know about self-directed IRAs is you want to make sure that you have enough in your account for any investment you do. Okay. Now, some people do $1 million real estate. Some people do a couple $1,000 for precious metals or crypto. So you don't need a whole lot of money to do a self-directed IRA. Okay. So what is a self-directed IRA? Like I said, self-directed IRAs are different from your regular IRAs in that we don't hold publicly traded stock. Okay. That's what your Vanguards and your Edward Joneses are for. We hold alternative investments. Okay. So what you would do if you have a retirement plan and you wanted to open an account with us, you would move money from your regular IRA retirement plan over to us to do an investment. Now, since we don't do stocks, bonds, and mutual funds, you would liquidate the amount you need and leave it in your account as cash. Once it's in a cash position in your IRA or your old 401k, then it can be moved over to us to make your investment for you. Okay. The only things you cannot do in a self-directed IRA are cannabis, life insurance, collectibles such as art or cars, things like that. But other than that, it's pretty much wide open. So go out there, you find an investment that you want to do. Well, some people do pig farms, some people do wineries in California. It all depends on what you want to invest in. You come to me with the idea, and I tell you whether it can be held or not. If I don't know, we have a compliance team that does a compliance on every investment. that we make sure that the investment can be held in a self-directed IRA. So you'll know one way or the other whether it can be done or not. And if there are any IRS issues with that investment. The type of plans. If you have a traditional, of course, it's a tax deferred account. You don't pay it. You're not paying any taxes until your distribution age, which is right now 73. You can take it out after 59 and a half without penalty, but if you take anything out, it is earned income and you will pay taxes on it. You just won't be penalized after 59 and a half. But at 73, you are required at distribution to take money out. Now, that's 73 today. So, a couple of years, I think it's going up again to 75. A Roth, you pay taxes now. Okay. But let's say you want to do an investment property and you want to put 150,000 into an investment property. Pay the taxes on the 150. There's a 5-year rule with the Roth. As long as you hold your Roth for 5 years and you're over 59 and a half, whatever you make above your initial investment is all tax-free. There is no distribution age on the Roth. Again, and it doesn't start from 5 years when you open an account with me. If you already have a Roth, it starts from when you first opened your Roth. So you can move Roth money from your account that you have with your regular IRA. You can move Roth money over to me. There is no tax implications because it's moving from one qualified plan to another. Again, after 59 and a half, as long as you've held it for 5 years, tax-free money. So it's good if you can afford it and you can do things like that. A Roth is a great idea. SEP IRA, again, you need to qualify for it. If you're self-employed, your contribution levels are much higher on a traditional than a Roth. Your SEP, you could do 25% of your compensation up to $69,000 a year. Okay, so you self-employed people, you don't have a whole lot of money. You want to start opening an account. So in 2 years from now, if you can max out at 69,000, now you've got over $138,000 to start doing an investment, whether it's a fix and flip or a buy and hold. As long as you have the money in your account to do it, a SEP is a great idea if you're self-employed because the contribution levels are much higher. Okay. We don't do too many simple IRAs. We really don't get that many. Again, it's for small businesses. If you are interested, I could get you more information on that. Solo Ks, again, the Solo Ks are good for self-employed people. You have to qualify for that. Again, your contributions are much higher than on a regular traditional on a Roth. The only thing about a Solo K plan that's different than all the other plans is that we don't do tax reporting for Solo Ks. So you would need to have someone do your tax reporting for you, whether it's a third-party administrator, an accountant, something like that. You would have to have somebody do your accounting for you. We do not. All the other plans, we do tax reporting for you. Even if it's a tax-advantaged account, we still report to the IRS. Okay? Covered Ls are for kids. If you have any kids and you want your kids to start investing, you can open up covered Ls for them. You can contribute up to $2,000 for each individual child. So that's a great way. All the money that you put in a covered L is used for their education, whether it's books, tuition, lodging. Everything in the covered L has to be used for their education. But it's a great way for your kids to start investing with you. And the money that they make on their return on their IRA goes back into the covered L, and it's for use for their education. Okay. HSAs, same thing. HSAs are used for medical expenses. You can invest in any alternative asset in an HSA. All the returns, whatever you make on your investment, go back into the HSA, and it's used for medical expenses. The one thing about HSA, you have to have very high premiums for you to have an HSA. Okay. that you would have to check with your provider. I don't know what the parameters are on that. But HSA is another way for you to be able to use medical expenses to invest, and then the returns you can use towards anything medical. Okay, so these are the different types of plan. And of course, there's, for anybody who used to be a teacher, there's the 403Bs, 457s for government. As long as you're not still active with those plans, you can use the money in those for investing. So if you're still working for a company and you have a 401k that you're actively contributing to that plan, they're probably not going to let you use that plan to invest with me. You have to check with the administrator of any plan that you are still actively working in. So teachers, any government agencies, if you have a 403B, 457s, or an active 401k, you're probably not going to be able to use that plan to invest. Okay. Once you're away from that company, like an old 401k or an old 403B, yes, you can use that money. They have no control over it from that point on. Okay. So just run by me what type of plan you have, and we can always discuss it on how it works and rollovers and things like that, depending on what plan you have. Okay. Here are the different options for funding a self-directed IRA. One, contributions. We went over to contributions. A traditional and a Roth, the most you can put in is contribute to a plan is $7,000 if you're under 50, $8,000 if you're over 50. And that just went up from last year. Okay. So if you're looking to do a real estate project, doing a $7,000 contribution pretty much isn't going to work, because if your IRA owns the investment, everything has to come through that IRA. Okay. So contributions are pretty tough to do unless you have an IRA and you have money and you want to contribute to your plan more, you can do that. But opening an account with $7,000 or $8,000, you're very limited in what you can invest in. Okay. Transfers. Transfer is a traditional to a traditional, a Roth to a Roth, two like accounts. Okay. Transfers are much easier and quicker than doing a rollover, because all it's doing is going from one custodian to another. Two like plans, traditional, Roth to Roth, a SEP to a traditional, because they're both tax deferred accounts, as a transfer. As long as they're like accounts, you can do a transfer. A rollover is more like for your 401ks or your 457s or your 403Bs. There's two types of rollovers. Indirect means you're rolling your money out and they're cutting a check to you, and then you have 60 days to do something with the money before you get taxed on it. A direct rollover means the money gets moved right from your custodian right to us. They'll cut the check and it'll come right to us. You won't have to worry about that check. It'll be deposited right in your account with us, and then you're off and running. A conversion is if you're going from a tax deferred account like a traditional to a Roth. So you're going from a tax deferred account to a taxable event. That is a conversion. Okay. So conversion is if you want to, let's say you want to start doing a Roth, but you have a traditional. You open a Roth, you convert the money, you will now pay taxes on the Roth, but everything, like I said, the 5-year rule, everything you make above your Roth after 59 and a half in 5 years is all tax-free. That is a conversion. Okay. Now, some people who want to do a Roth but make too much money, there is always the option of the backdoor Roth. I'm sure some of you have heard about a backdoor Roth. That's where if you make too much money in a Roth and you can't contribute to a Roth, you can open a traditional, contribute to the traditional, and then you can convert it to a Roth. That is a backdoor. Okay. We can discuss it again. If you want to open a Roth and you're making too much money, you can't do contributions anymore because you make too much, you can do the backdoor Roth. And again, if you have any questions on it, we can go get into the weeds with it at another time. So here are some possible investments you can do. Like I said, 85% of what we do is real estate investors, investment properties. If you yourself or you know somebody who's looking to do an investment property, It has to be an investment property. One, it can't be a property you already own. Okay. It has to be a new investment. It can't be a property that you are going to buy for yourself and live on that property. Okay. None of your ascendants or descendants, which means you can't use investment money to rent it to mom, dad, grandma, grandpa, your kids. They are prohibited. Okay. So investment property, you could do fix and flips. You can do buy and holds. You can get into syndications. You can get into joint ventures. So there are different types of real estate investments you can do, but it has to be a new one. Can't be something you already own. The other thing is that the investment property will not be in your name. Your IRA owns that property. You do not. Okay. So that's what keeps it tax advantage, because it's in your retirement name, not your own. So if you're looking to do an investment property, you have to get your account open with us and get all the necessary documents, because your property, all the paperwork, all the closing costs, the deeds, all the name of your IRA, not your own. Okay. And again, I have individual information on this. If you're interested in this, I have more information I can send you. I can go do a whole presentation to you just on how to do it. Okay. And how to work through it and understand it, and quicker than, I'll give you a little more time than 20 minutes. I pretty much do presentations for a longer period of time until you really understand it. Okay. But these are some of the things you could do: private placements, private stock. You could do hedge funds, pre-IPOs. A lot of people like to lend money. You can use your IRA to lend money to other people. You're now the bank. You can do promissory notes, principal, interest, whether you do a secured note or unsecured note. You make up a note and you can use your IRA to lend money to other people. Now, again, you can't lend money to yourself. You are disqualified from yourself. You can't lend money to your mother, father, grandmother, grandfather, or your kids. You can lend money, though, to your brothers, your sisters, your aunts, uncles, and cousins. I do not understand why the IRS has certain rules, but some people don't have the rules. So, but just know that you can lend money out of your IRA, and you're acting just like the bank. So if you know somebody who wants to do an investment property and they don't have enough money and you want to lend them money, you can use your IRA to lend money. You write up the promissory note, and whether you trust that person to do an unsecured note or note. These are just in cryptocurrency. You could do precious metals. So there are a lot of things that you can do that you probably didn't know that you could use your IRA to invest in. Okay. Don't hold me to the last one, because I don't know what social impacting investing is all about. I could always find out if you are curious about what that is. I do not know exactly what that is. But again, these are things that outside of real estate, if you're interested in going forward with, these are things you can look into. Okay. And I'll explain to you how it works, and we'll go from there. Okay.
Yep, you have about 3 minutes left.
Okay. Prohibitive transactions. It's just, all this talks about is that there are certain things that you're prohibited from doing with yourself. You can't lend money to yourself. You can't use your IRA to buy a house for yourself. You can't use an IRA to buy a house for anybody. Okay. It's an investment property. Rentals, syndications are things you can do. Okay. No self-dealing. Okay. You are disqualified from yourself. So you can't use your IRA to buy a house for yourself. You can't use your IRA to buy a car for yourself. Investments. Okay. Again, we can get into this at another time further in. Consequences of prohibited transactions. The IRS is going to distribute your money to you. You're going to be in big trouble. They're going to fine you, and they're going to go back all the way to when you first did your prohibitive transaction, and it's going to cost you a lot of money. Okay. Disqualified people. You are disqualified from yourself, your husband, your wife, your kids, grandmother, grandfather. They're disqualified from you. Now, if you're looking to do a real estate investment, even though you are disqualified from these people, you can partner on a deal together. Okay. They just don't want you commingling money. They don't want you to open an account and have your wife throwing money from her checking account into your IRA. That can't happen. Okay. But if you want to go on a deal together with a disqualified person, you can partner on a deal with a disqualified person, but it has to be a partnership. Okay. Keep your percentages the same way through your whole deal, but you can partner with someone if you don't have enough money. Okay. If you don't have enough money to come up with it, I will tell you other ways you can do it, whether you have to do it through a mortgage, whether you want to do it with someone disqualified, whether you want to do it with your IRA and cash, you can do that. There are ways to partner on deals, even though they are disqualified from you. Okay. If you're interested, we can go get into it. I will run you through how it can be done. Okay. One quick thing, LLCs. You cannot use an LLC that you already have. It has to be a newly formed one. It has to be done through a specialized attorney called an ERISA, ERISA. ERISA attorneys set up LLCs for retirement plans. Okay. They are versed in how to do this. Okay. They will help you set up the LLC. I will help you set up the IRA. The IRA will connect with the LLC, and then you will have checkbook control. You do not need to have an LLC if you do not want to. You do not need one. It's just a matter if you want checkbook control or not. Okay. And again, I can go over that. I have documentation on that. Same thing for if you're looking to mortgage property. You don't have enough money. You want to mortgage a property. It has to be a non-recourse loan. Okay. It cannot be a private loan. Can't be a hard money loan. It has to be a non-recourse loan. We have non-recourse lenders on our website. You don't necessarily have to use one of ours, but it has to be a non-recourse loan. Now, what that means is that if anything happens where you stop paying on it, their recourse is to only go after the property. They cannot go after your IRA. They cannot go after your IRA or you personally. They only go after the property. It's called a non-recourse loan. I have information on that. But again, if you're looking to leverage property, it has to be a non-recourse loan. Okay. I don't know how much they need down, but they're taking a big risk on a non-recourse. So you're probably going to have to come up with 40, 50% of it if you are looking to mortgage. Okay. But just to know, it just can't be any lender to lend you money. It has to be a non-recourse loan. Or, like I said, find someone to lend you money or partner with somebody if you don't have enough to stay away from having to pay taxes on a non-recourse loan. Okay. So again, if you're interested in all this information, I have it for you. Please reach out to me. Opening an account only takes about 1 to 2 days. Doesn't take long at all. The funding is the longest part. The custodian, the money comes from, they could take up to a couple of weeks to get us the money. Okay. The last part is for us is the compliance. We have a 5-day compliance on any investment. Okay. So if you're looking at an investment property or doing any kind of investment, you probably want to do it about 2 months out. Okay. So there's about 3 to 5 weeks to get through the whole process. Okay. So if you're looking to do an investment property tomorrow, it's not going to happen. All right. So you don't want to miss out on a property. So if you're a couple of months out, you want to start rolling on this process. Okay. If you have any questions, feel free to reach out to me. I will go over everything you need to know. And that's pretty much it.
Okay, great. Thank you. If you want to put your contact information in the chat, that would be really great. People could get a hold of you if you like. And Mr. Clark, Dylan, you had your hand up earlier. You had a question. Would you please like to ask Jack the question you had?
Yeah, super high level. I'll try to make you or let you answer this short as possible. I've got my ERISA LLC with a SEP that I contribute to, so everything's ready there on the check writing side, self-directed.
Okay.
When it comes to real estate, you were stating that you have to buy everything under that IRA's name. What about on the hedge fund side of things? Can I, if I own my own hedge fund, can I just port those assets directly in, or is there something wrong with doing that?
Yes, that's your own. You are disqualified from yourself, so you cannot do it. You're already in an investment, so you can't do that. Has to be
Perfect.
new.
How do I get it?
How do what?
Well, the ERISA LLC and whatnot was set up before the investment went live and the docs were formed.
The hedge fund went public?
The hedge fund, like the offering docs and all the
Yeah.
registration.
Where'd you go?
He broke up.
I don't think he just broke up. I think he's left. There he is.
Well, I missed the question. He was in something about he was in a hedge fund with he has an LLC.
The hedge fund entities were set up after the IRA or the SEP was created. The self-directed SEP was created. So SEP first, hedge fund second.
It's okay. So you're invested into a hedge fund using your self-directed SEP IRA, correct?
Correct.
All right. Who's the custodian of your plan? You're in a self-directed IRA company like mine?
Yeah, very similar.
Okay. So you're invested into a hedge fund with your IRA. And the question
Yes.
is, you own the hedge fund
Yes.
and you're invested into your own hedge fund?
Yes.
Did your IRA company approve this?
Yes.
They did.
Yeah, they said it was fine because the hedge fund was formed after.
I would.
Well, you
That
had, Jack, you had said that you could buy a piece of property with your IRA and with your cash. Why can't
That's
you do that?
that's part if you're partnering on a deal, but it has to be a newly formed investment, and it has to be the problem. The question I have here is it's his own hedge fund.
Yeah, but he
Okay.
formed it after he already had the IRA, and the IRA is part of
Right.
the initial investors.
Yeah.
And he's also
what-
an initial investor.
Yeah. So, are you majority owner of that hedge fund?
I'm over 20%.
Okay. And your question is, you want to add to it?
Well, I'm just making sure I'm good. You were talking about real estate specifically.
Yeah.
So you made me question the company I'm with for a second.
Yeah. The thing is that I would have to, me personally, I would have to have my compliance team take a look at the docs. Because right now my spidey senses are going off, thinking there might be a red flag here.
It was the ERISA LLC and SEP IRA
Yeah.
were all formed in August of 2020. The
Okay.
hedge fund was formed in June of 2022.
Okay.
I own less than 50% of the hedge fund, but I do own it. And my SEP IRA went in as an initial LP contribution.
And what kind of ownership does it have? Does it have just a few percentage, or is it 50%, or?
So it's limited partnership interest. It owns 1.5% of the total issued securities right now. If we go to full offering size, it'll own 0.15% of total units, and if I don't contribute anything else.
Yeah, what I would you have an LLC in your IRA. I mean, in your self-directed IRA, correct? It's formed an LLC.
Yeah.
Okay.
Correct.
I would contact the ERISA attorney. Did you contact them?
Yeah, they set it all up. I didn't set it up myself.
They said it was all okay.
The ERISA attorney.
Well, then you should be okay.
Yeah, you should be as long as the ERISA attorney says it's okay. You should be fine.
I've got legal coverage if it's not.
Yeah,
Okay.
you do. I know you recorded everything.
Yeah, I would definitely. Any questions about that when you're in an LLC? That's the good thing about an ERISA attorney is they are for you. They're for any questions. They're your legal counsel. That's what you pay them for to set up the LLC. But they're also there to help you try to get out of any prohibitive transactions or something that you've done. They'll try to rectify it or help you work it so you don't have to have it distributed back to you. So
yeah, it was cleared by all parties. So
okay, there you go. As long as they're happy with it, they're good. Like I said, right. I don't do the compliance on 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 investments. If I ever question something like this, I always revert to my compliance team. Or if you're going to an LLC, I always revert it back to the ERISA attorney because they are more versed in the law. I'm not. So they know
No,
better
you're all
than I
good.
do.
You
Okay.
just never know when that one random person may have read that one line that matters.
Yeah, you're
Exactly.
right.
And that's what the whole verbiage of the operating agreement is all about. And again, the ERISA attorney is there to help you with questions like that. So if he said it's good to go, then you have my blessing.
Okay, thank you, Dylan. Eugene.
Thank you. Did I hear you say it takes you 5 weeks to go through compliance review?
No, 5 days.
5 days. Okay.
No, to open your account only takes about 1 to 2 days. Okay. The funding part is the longest part and the part we have no control over. So if you have an account with Vanguard,
No,
okay,
I'm talking about if we're about to, I'm talking about if I'm going to make an investment in something, how long does it take to get through your compliance team to make sure that that investment is something that can be done?
3 to 5 days is our compliance, depending on how structured the investment is or how complex. But 3 to 5 business days is how long it takes. And
Okay.
again, it depends on how busy we are because there's a lot of documents that have to go through. But like I said, if you're 2 months out from an investment, that's good. Let's get it started. It's not going to take you 2 months to get your account open, funded, and make the investment for you.
Well, I already have a self-directed IRA, but and I used to be with Equity Trust, and I moved from them because they took too long to approve deals.
Yeah.
I thought I heard you say 5 weeks, and I was thinking, boy, that's that's ridiculous.
No. If you can transfer, you can change custodians. We do transfers in kinds all day long.
Yeah, he knows that.
Yeah. Okay.
Yep.
Thank you.
Thank you, Eugene. Ashley.
Hi, so this is Fidel.
Oh, Fidel. Hi, Fidel.
Hi there. I was gonna ask, as far as because I do have mine in the 401k and I wanted to transfer over to the IRA. Once I get that money over to that IRA, you guys I can build an account. You'll use that fund for an investment into rental homes to help me build.
They won't use it.
So
you use it.
I use it, and you guys guide me through those steps, or how to?
I will guide you through those steps.
Got it.
Jack's company will say, yes, you could do this, or no, you could do this, but we wouldn't send anything to your IRA that wasn't compliant.
And then once your account is funded, we tell you your account is funded, and then you tell us to make the investment for you. That's why it's self-directed. You make the decisions. We're just a custodian.
Okay. And then as far as whatever I transfer over, is that amount gonna be like the amount that I have invested, and then it builds and my investment amount builds? So
the money that goes into your IRA with me, okay?
Because I don't mean to cut you off real quick though, because I constantly get that amount builds with my 401k because I invest through my company's check. So I'm curious on how it works there, and how, since it's already going to grow, I'm wondering what growth will you guys offer as well. Sorry.
We don't grow. We don't offer any growth.
IRA is like a 401k, in other words?
No.
No. We're just a company. Yeah, we're just holding the money until you tell me to make the investment for you.
Got it.
That means the money goes from your IRA with me out to your investment to pay for your investment. Everything.
Okay.
The returns you make, whether it's rent or any kind of return on investment, that goes back into your IRA with me. So
that
we
goes,
hold.
Okay.
Yes.
That goes. So then, got it. So the IRA builds there.
That's the IRA build, it builds with your investment. So if you go into something that's paying an 8% cash flow, you'd be getting 8% more a year based on what you invested,
including the
20. Well, yeah, let's just say, because my math works on 100,000, you put $100,000 into something, and you get 8% back, you'll have $108,000
Back into the IRA.
back into the IRA. Each year you won't get the 100,000 back. You'll get the 8,000 every year until the property sells or they do a refi and give you your 100,000 back.
Yes.
So
But you could, but that 8,000 is going to be needed for construction, landscape.
No. We work in limited partners. They're a partner. So that 8,000 will grow, and now
I see.
over a few years, you now
I got
have money to go do another investment.
Got it. And
So then eventually you have 8 or 10 or 15 different investments that are all cash flowing or building back into your IRA account. And the Roth is whatever money it makes is not taxable because it's post-tax dollars.
Got it. So once I transfer to the IRA, that's when I'll build with you guys if I'm interested in starting that investment process.
Exactly. But you have so here's the thing, and I think Jack is going to support this. You are working for a company that's got a matching Roth or matching IRA.
Yeah.
401k, you can't take that money out. You can only use from a past that you no longer work for.
Got you.
Yeah, you still have a 401k with the company you work for. You have to contact the administrator and ask them.
Yeah.
They probably won't let you because they don't let you have a second custodian. If you have an old 401k or if you have an IRA, those are perfect. Those are the ones that'll work with. Okay?
Yeah. So if you work for a company before the company you work with now, you could roll that into a self-directed IRA.
Yeah.
And if it's a regular traditional and you want to go to Roth and your accountant tells you could convert us so much.
Let's just say if I was gonna switch companies, now that no longer belongs to that, and now I have the option to roll that over then.
Yes. And start investing.
But you have to find out from the administrator how soon after you leave your job that you can start doing it. Because some custodians won't let you do it like the day after you leave your job.
I got it.
There might be some kind of grace period. Okay.
Perfect.
So check with the administrator.
Thank you, Peggy. No problem. That helps a lot. And you'll hear from me. I don't know how soon, but we'll see.
Also, I guess since I'm an example, I want to add something for the gentleman that's speaking. I rolled $500,000 from the company I work for into a self-directed IRA, but I put the money, when it went to the IRA, I put it in the stock market inside of the IRA. So the IRA owned the stocks until I was ready to invest in real estate. So it was just like I was still inside of a 401k, because the 401k was just the stock market anyway.
Nice. It's similar to kind of what I want to do. I want my money to keep growing, at the same time take it to somewhere where I don't get as taxed, as Peggy has explained to me, and I could use that as keep it growing through an investment. So definitely thank you guys for your time though.
You're welcome. And did Ashley was on earlier. Did she have a question?
Here with me, yeah.
Oh, no, I got everything that I needed. Thank you so much.
Okay, super. That's great. Does anyone else have a question? Because I have a whole bunch of questions. Jack, you lucky guy, you. Okay, so you don't know what social impact is. So someone has an annuity and they want to roll that into a self-directed. Is that possible no?
Annuities or no?
It's an insurance product that can't be rolled. So they could only do there's $8,000 or $7,000 contribution.
Yes.
Oh, okay. And then this will be compliant, so you might not know the answer. But someone told me that if your IRA is going to buy a piece of property and you own the property next door, you can't invest in that property because it will. I don't know. I still never figured why.
There could be some issues with, as long as it's separate property.
Yes,
they can do it as long as they don't commingle those properties.
Yeah, they don't commingle them, but they say that I I personally will benefit from my IRA opening the property next door.
Well, their property, if it's two different, if it's separate lots,
Yep,
when they want to use their IRA to buy the other lot,
yep.
they
But they'll
probably,
benefit, right?
no. They'll only benefit if they're trying to use both lots for one purpose. If he's just using the second lot for, if he has a property next door that has nothing to do with his IRA, and he wants to buy the property next door,
Mm-hmm.
and he wants to build on the property next door, as long as he doesn't do anything with the property on the other side, not associated with his IRA, then he's good to go. They have to keep that separate.
Okay, well,
can't
there's
commingle
another
that.
IRA company that says you can't do that, so isn't that interesting?
They're
Okay.
separate. They're telling them they can't do it because of why?
Because it'll benefit me it'll benefit me financially. Because I'm
Because you own
invested in the IRA that owns the property next door.
I
That's just
think
what
it
this-
was probably, that has to do with the property line. I'll run it by my compliance team.
I don't mean, whatever. So the
I'll get the
IRA builds a apartment complex, fills it up, sells it, the money goes back into my IRA. How did that well, it depends on what I'm building on my property, right? I don't
Yeah,
know.
as long as it has nothing to do with the other property, there shouldn't be an issue, but I will definitely get an answer for you on that one.
Okay, so you have all these things listed, life insurance, collectible, cannabis. You said you can't do those.
That's
What
correct.
what about medical? I mean, is it not called cannabis? It's called something else? Because there's now medical cannabis, which is,
Anything with the word cannabis or anything associated with cannabis, because our charter is held in South Dakota, it's considered a class 1 narcotic. I know, even
I
just the
wonder-
word,
I
it's
wonder
kind
if
of
it's held
strange.
in California, if that would be, because it's legal here.
It depends on the custodian. Most custodians are chartered in South Dakota, where it's still considered that. But
Oh,
there are custodians out there that are not chartered in South Dakota, where it is not considered a class 1 narcotic. So there are custodians out there
okay.
that will hold it. We
Yes,
are not.
you have to check with your custodian, whoever that
Yeah,
may
where
be.
their charter's held.
Okay, so the Coverdale, the 2,000 you put in every year, someone told me, and please correct me, that's why I'm asking the question, that when it invests in something, that all the money that the capital gain is taxable. Is that true?
Any capital gains on anything in an IRA is
But
either
it's a
taxable.
Coverdale,
Oh, Coverdale's used for only expenses for education.
right? But I'm taking the Coverdale for my
Yeah.
grandson. And I'm building that up into something so that it can invest, so it can make more money. So I don't have to keep adding 2,000. I could keep adding the 2,000, but I wanted to build. It costs a couple $100,000 to send your kid to college now. So
Yeah.
I want that to build like at the 20%. Am I going to have to pay capital gains on that 20% it earns?
No, because it's all going back into the Coverdale
Which
for
is
expenses. As long as
And
they
a
keep
Coverdale's considered IRA?
No, it's considered a retirement plan. However, as long as she uses those gains for education, she's not that the only reason she would get taxed on it is if she used it for something other than the child's education.
Okay,
That's what the whole idea of a ESA or Coverdale.
that's what I thought. And then somebody told me that you have to pay taxes on all the capital gain. And I'm like, well, that's.
You don't pay taxes. No, but the whole idea of using a ESA for your kids is to build up. They can invest, and the investment they can invest with you. Okay.
Yep.
The gains go back into the ESA, and that's what the gains are for, the education. And as long as it's used for education, there's
Yeah, you have to start your Coverdale really when your kids are born, because $2,000 a year.
I think you can do it up until they're 18 years old. You can contribute up until they're 18. Okay, and then they
That's
could use
not
it.
enough to send them to college at 2,000 a year.
Well, that's why some people, some people don't do the Coverdales, but with other companies, they do the 529.
Oh, yeah. Is that taxable?
I don't know about anything
Okay.
about 529. I know the difference is that 529 though are only for college, where
Oh,
Coverdale,
Coverdale's for education.
that's right, Coverdales are for everything.
Yeah, it doesn't
So,
have to be college.
right.
Okay. Yeah, I don't know. Does anybody know what social impact is?
Yeah, somebody just put it up there.
Oh, they did?
Is an investment strategy that seeks to generate financial returns while also creating a positive social or environmental impact. Investors who follow impact investing consider the company's commitment to corporate social responsibility or duty to the positive serve society as a whole. Okay. I have not had anybody go into this. I've never had an investor. Like I said, I've been with the company 4 years. I've never had anybody go into social investing, but it's something that can be done.
Well, Patricia, we'll have to give that a try. It's a scheme, ESG. Oh, okay. And Dylan, why do you say ESG is a scheme?
Avoiding tobacco and porn. Oh,
So-called double bottom line.
yeah. I don't know. If anybody's interested, I'll get a better definition of if anybody in our company has ever invested in this. So
Similar to avoiding. Is that the tax, Dylan, you're talking about? Avoiding the tax on tobacco? Also called double
No,
bottom
it's just
line.
to make people feel good about life. That's what it
Oh.
comes down to. There's no genuine benefit, and if you actually look at the historical returns of something like this, they're god awful.
You're talking about the ESG?
ESG, social impact investing, all of it.
Oh, okay.
It's
And
just
yes.
you get a lot of government funding out of it though. So
Oh,
there is that. It's really good for sponsors, really bad for LPs.
okay. I'll keep that in mind. And Norma, what do you mean by double bottom? Bottom?
Well, yeah, that there are two bottom lines that are being considered. One is the financial bottom line, in terms of being profitable. And the other bottom line is that social good, whatever it is, with, job creation or environmental impact. And, all the data that I've heard has been the opposite, that there is, well, and I usually know this in the context of real estate investments. The returns are above average. So, I think it's like anything else. You kind of look at the fund, you look at the sponsors, it'd probably be hard to generalize about any investment strategy, just to say they're all good, they're all profitable, they're all whatever. So.
Yeah, well, finding a social environmental impact, how do you determine that it actually had an environmental impact? That would be and then
I'm going to get you the answer to all this tomorrow. I'm going to find out.
Who's going to come in and say that it had or had not had an environmental impact? Is the IRS going to come in and say that?
Yeah, I don't know, but I'm going to find out what that is all about. Again,
Okay,
I've
that'd
never
be
had
great.
anybody do it. I'm going to have to change more verbiage in my presentation because some of this stuff it's outdated or no, but nobody's ever invested in it. So I don't even know why I left it on there.
Well, because you never know who's going to be on your show that might be interested in that.
That is a true statement.
If you had a super young crowd like the Ashley Fidel group, and you had a whole group of them, they're more into that than someone like me or most of the people on this show, because they're all about environmental impact and social media kind of thing. So they like to help others. So
Then I will definitely
you never
find out.
know. You never know. You just
Exactly.
need a little bit more so you could explain it a little bit.
Mhm.
So we're almost at the top of the hour, and I want to know if anyone had another question. And if not, we can welcome Jack back at another time.
You guys have my email address. If you have any questions, feel free to reach out to me. Again, I can get much more into the weeds about partnerships, LLCs, non-recourse loans, anything you need to know about syndications, passive investing. I have information on everything. So feel free to reach out to me. Let me know where you found me, so I know that it was part of Peggy's group, and we could take it from there.
Thank you, Jack. And we're going to send this out to everybody so they will have your information and they can get a hold of you if they wish.
I appreciate it. Nice to meet everyone. Peggy, thank you so much for this time. I appreciate it so much. Anything I could do for you, you let me know.
Okay, great. Thank you very much. Bye-bye.
My pleasure. Bye, guys.